एक सेकंड. Hello and welcome to SRIRAM's IES. Is it mic on? Hello and welcome to SRIRAM's IES. As you all know that we have been into the series of PYQs, and in this series, this will be our third lecture for economy. In today's lecture, what we will be discussing is the topic which we rightly know that has a highest weightage after the external sector in UPSC PYQs. If I tell you simply, money and banking in itself had around 30 plus questions. This topic has given 30 plus questions in the past 10 years of UPSC. Money and banking topic will be discussing 10 questions, and there will be approximately 3 such videos in which we will be covering this money and banking. All the PYQs of 10 years will be completing here in this series. Now, beginning with this topic, in this money and banking, as I said, there are 30 plus questions, and after this there comes external sector, which had a score of around 48 questions from past 10 years. Now, beginning with money and banking, why do we need money and why do we need banks? That is the prime most aspect of the modern economics, and that is where the modern economics lies, because after the barter system we shifted to money, and money in itself is an instrument of exchange. The value of money determines its price in the market. The value behind the money, or the money which you might have, you might remember that there was once upon a time that we had full-bodied money in terms of gold, which was a full-bodied money, that is the face value and the intrinsic value of that coin was equivalent to each other. But later on we developed different forms of money, whether it was paper currency or whether it was the plastic currency in your cards or in your wallets. In the present times, we see Bitcoin, we see digital e-rupee, and UPSC has been evolving its questions also in the same pattern as the world evolves. Therefore, beginning with the questions, you will see that the first question talks about, or the first slide talks about the banking system. That is how basically we need to first understand that how banks play a part in the monetary system or in the money supply at large. Just to understand the basic concepts, I'll simply tell you that if you have basics clear, as I have been telling you always, if you have basics clear, your questions become very easy. You will solve the questions in the exam center itself. Don't worry about that. Just make your basics strong. Now, understanding fractional reserve banking system on which the modern economics lie. This reserve system works on a simple principle, that is just a deposit of 100 rupees in banking system can create n number, or multiplying it with the effects of banks and then the habits of people to save their money in the banking system, formalizing the economy. This deposit of 100 rupees can multiply itself and can create a larger money supply in the market. How does this happen? That 100 rupee, a simple deposit, a simple saving of 100 rupee in the banking system can convert to rupees 500. That is the effect of money multiplier, and that is why we need all of the system of banking to create more wealth and to create more money in the market, so that our economy grows. It was first the gold based or the full bodied money, then later you will see that how banking system evolved, and currently what we have is this fractional reserve system in which just we are keeping a small amount of reserve. Before this, what we had, a bank must have had equal amount of reserve of gold as the amount of currency which it is printing and supplying in the market. Now, understanding these two concepts of fractional reserve banking, what actually happens here is a simple amount of 100 rupees which was deposited into the bank shall be kept, a reserve of this money shall be kept aside by the bank itself, say 10%, and 90% of the amount of this shall be lent into the market, so that the 100 rupees deposit, 10 rupees shall be a reserve, and 90 rupees will again go into the market. Then this amount shall go in the form of loan to a person. This person shall invest this money, or he can have different plans with his money. He can use his money for, you can say, daily expenditure or investment in the industry, which will in turn create more entrepreneurship. Once the entrepreneurship gets created, this will help us in increasing the money supply by wages, rent, which you know that these are the factors of production, which means that these factors of production will now be cheaper in the economy, which in turn means that the industry in the economy will run faster. Therefore, there will be industrial growth. Again, the another plan of this person can be that he will spend this money in his daily expenses and again save a part of it in the bank. Once he saves a part of it, suppose he got 90 rupees loan, he invested 45 rupees or he invested 80 rupees of it, kept 10 rupees with himself, invested 80 rupees in the industry. This industry supplied this money into the market indirectly, and then this money again went to another bank. Therefore, this money supply will continue rotating and revolving. This is how the banking system is prime most important in modern day economics. That is why this importance has led UPSC and all of us who, and you particularly, the future bureaucrats, to think about that how this money is actually helping our economy to grow. Now, understanding the questions and beginning with the questions, the first question talks about legal tender money. What is basically legal tender money? Is there anything which is illegal or which is not a legal tender money? Or is this legal tender money a limited or unlimited legal tender money? What it is? And why do we call money as legal tender money? You must understand that every concept of economy is linked. Two things. One is static and another is current. If you remember that in this government only, there happened to be a time when we faced the demonetization. Fine. In this economy only, we faced the demonetization. And while we were seeing the effects of demonetization, we saw that this decision was taken and it was said that the rupee 500 and 1000 notes shall not hold the value of legal tender money post the September decision or post the November decision of 2016. Now, understanding the concept behind legal tender money is that there is a sovereign power which backs this currency. The sovereign authority is backing the value of this currency, that we will pay you back this amount or the value of this amount which is written on the note. This note is basically called bill. Why are we understanding the bill? The concept of the bill, you can say that it emerged in the ancient times itself. Understanding this, that this is something which is legal in nature, therefore it has legal backing, the sovereign backing behind it, which means that money which is paid in this currency has to be accepted by the creditor. No one can claim that I will not accept this money. Therefore, at present times we have limited legal tender money, which is in the form of denominations of coins. These coins, any payment, any amount of rupees can be accepted in coins, but it should be less than how much? 1000 rupees. However, there is unlimited legal tender money to all the currency notes any payment in terms of notes cannot be denied or has itself backed by the concept of legal tender money. Now understood all legal tender money and then limited and unlimited legal tender money. That was question number 1. Next, the bank money in the form of checks, drafts and bill of exchange. These are the money based instruments. These are the instruments of exchange, not money per se. Therefore, you cannot call it legal tender money. This is not legal tender money. Next, which of the following phrases defines the nature of hundi? All the students here might have thought that it is a question of medieval era or it's a question of medieval history. Yes, it is Harsha or ancient, sorry, not medieval but ancient. In the medieval era, we saw the term of fanam. Fanam had the same concept, that the two concepts of hundi and fanam which have been asked by UPSC from the historical aspect of economy, or you can say the evolution of economy. Basically, you need to remember that while you are reading and preparing yourself through GS, you need to keep your eyes open and wide while you see such terms which are related to economy, whether they are ports, whether they are economic terms, whether that is this hundi, which is a bill of exchange, which was used in the period of Harsha to settle what? Monetary claims. This is bill of exchange. And in modern day, this hundi was earlier times in the, you can say in the beginning, in the post-independence or before that colonial period also, we saw the presence of hundi, that this instrument was per se used to settle the claims. And this is something which basically holds the personal trust of the person who is issuing it. The acceptance of hundi lies on the personal trust of that person, that this is not something which is backed by a legal power, this is not something which we call a fiduciary money, or this is not something which must be accepted. This is a receipt and this bill is to be accepted and transacted only based on the personal trust and the transactions which are there in the sandbox, which have the chemistry between the receiver and the issuer. Done? So this was a bill of exchange. Just to make you vigilant about this thing, that you need to keep your eyes open and wide for economic concepts in history also. Chalo. Next question talks about the commercial banks. It says which of the following is not included in the assets of commercial bank. So why should we understand the assets of commercial bank? As I said earlier also, the banks earn their profit through assets. Okay, one thing. Second, what are these assets? These assets are basically investments. How do they create these assets? Do they have these assets and then they invest it? No. The basic thing is that banks will generate loans. These loans will be issued to those people who actually are investing this money. They are taking out this money, then investing it into the industry, or you can say entrepreneurs. Further, you need to understand one more thing, that banks, while taking the money and making them assets, they earn profit in terms of interest. They earn interest on those loans. Understood? And one more thing, that banks, if they borrow money from somewhere, whether that is another bank or whether that is the central bank, they have to pay interest on that. Therefore, they have two things. They generate loans from somewhere or they issue loans to someone. In both the loans, they either pay the interest or they receive the interest. That is how banks earn their revenue, or they use this revenue to pay their interest. Now we are done with this concept. Understand, which of the following is not included in the assets of a bank? Which is not included in the assets of the bank? Which shall be included in the assets of the bank? The loan which it generated. The loan which it generated to receive the interest out of that. So all the loans of a bank are actually assets. Next, what are the liabilities of the bank then? All the loans on which bank has to pay the interest. These are what? Liabilities. Understood? यहाँ तक clear है? बस. Now समझो. Which of the following is not included in the assets? So advances, these are loans only. These are assets because they will earn interest to the bank. Investments, any bank investing anywhere, or leave aside a bank, if you are investing somewhere, that is an asset for you because that will generate revenue for you, that will generate a return for you. Therefore, this has to be an asset either of a bank or a person. Money at call and short notice. Any money which bank has at call or short notice, that is a money which is in reserves of the bank, which is highly liquid for the bank, that cannot be an asset. Okay? That cannot be, that has to be an asset because that is available with the bank and they can settle their disputes, they can settle their withdrawal claims throughout this money, through this money. Okay? Now what else is remaining is the deposits. Now these are those deposits which people have deposited with the bank. People came up with their money and tried to save it with the bank so that they earn a simple saving account interest of 4%. Or you can say this is just a demand deposit which people can come and withdraw at any point of time. That is how this works. That is why this deposit is a claim on bank. This deposit is a loan on the bank, not an asset of the bank. Understood? Remember that every word counts and every word has to be understood very well. Loans, or you can say liabilities of a bank, include equity, share capital, whatever has been subscribed to the bank, whatever has been paid by people to the bank, that is the share capital. Borrowed capital. Borrowed capital includes deposits, customer deposits, or the certificate of deposit, CDs, whatever the CDs bank have issued till date, on which it has received the deposit in the equivalent amount of that CD issued. What are bonds, derivatives, and interbank market funding? All of this is a liability for the bank. Assets, these are those loans which bank has generated. These are all the liquid assets in which the bank has invested its money into. And any other asset, for example, a bank has its branch, it has its buildings, it has its cars, it has its, you can say any other thing, computer, assets, furniture, that is the asset for the bank. Now, this was one of the trickiest questions which UPSC asked, but very simple to understand and very simple to comprehend. बहुत ही easy question था. Breaking the question, always remember, break the question and understand it bit by bit. It says if you withdraw, what are you doing? You are withdrawing money, 1 lakh rupee from cash, in cash from your demat account, from your demand deposit, not demat, demand deposit. Remember the term? Demand deposit. You are withdrawing 1 lakh rupees from your demand deposit. What shall be the immediate effect on the aggregate money supply? So what is the effect on the money supply? First of all, understand what is money supply. If you remember the keywords, M3 is the money supply. This M3 includes M1 and M2 into it. Per se, you need to remember that M1 is this demand deposit. So therefore, if you are affecting something into M1, which is already included in M3, which means that there will be no such effect in the money supply. It will leave it unchanged. Why so? Because just to understand the fact that M1 includes these demand deposits, and these demand deposits are actually included into M3, which is basically the money supply. Therefore, there will be no such effect or no such immediate effect. There is the key word which UPSC has used is immediate effect. There will be no such immediate effect on the aggregate money supply. Next question, which one of the following links all the ATMs in India? This is per se a function of this NPCI, which basically deals with the payment system of India. Okay? All the payments and settlement system, whether that is NEFT, RTGS, IMPS, whether that is UPI, all of it is dealt by this organization called as National Payment Corporation of India. This NPCI has also issued, leave the numbers aside, we do not need the numbers for prelims, but yes, we need all of this to make sure that we know what are the other initiatives of this NPCI. It issued or it helped in developing the infrastructure of UPI, RuPay debit card, e-Rupee UPI and other NFS 123 Pay, which basically works on simple mobile phones or GSM based mobile phones. All of this payment infrastructure is basically dealt by the NPCI itself. Done? Next question talks about the very key topic, that is money multiplier in an economy. This money multiplier in an economy increases. Remember, the money multiplier in an economy increases with which one of the following? How do you think money multiplier will increase in the economy? As I said in the start of this video, that money multiplier, how it helps in our economy to multiply the money or to increase the amount of the money. A simple deposit of 100 rupees will convert itself and will multiply into rupees 500 by two things. One, banks. Is it enough to have banks? No. There should be people who are continuously depositing or who are saving or who are depositing their savings into the bank. That is, there should be habit of people to deposit money through the banks. There should be more banking and the spectrum of all the banks should increase. That is why we came up with the policy or we came up with the scheme of Pradhan Mantri Jan Dhan Yojana, in which UPSC also asked one more question on this, that was about the banking correspondents. Who are these correspondents and how do they work? All of this was done only to ensure what? To ensure financial inclusion in India. Done. Therefore, money multiplier ka jo concept hai, it was based on just one thing, that is the habit of the people. This was the answer of this question. Done. Money multiplier, how it actually helps or how it actually works. It is simple. A simple deposit of 100 rupees which was taken by a person named A. He'll deposit this money into a bank. Suppose ICICI Bank. ICICI Bank. This ICICI Bank will keep a 10 rupee, you can say reserve, and will lend out 90 rupees in the market. This 90 rupees was taken by a person, say B. This person will again deposit this amount into the bank. What will the bank do? It will create an 8 rupee reserve and lend out the rest of the 72 rupees. 90 rupees. He will again create a 9 rupees deposit. Because he has now got the 90 rupees loan, he deposited 90 rupees into the bank. Bank will create a 9 rupee deposit and will lend out 81 rupees in the market. Again, this will go to a person C. He will again submit or deposit these 81 rupees into the bank. This bank will create X amount of reserve and lend out Y amount of money into the market. This continuous chain of banks till the amount goes to zero or till the amount, the reserve of the amount equals to zero, will continuously grow, the money will continuously grow, and then you will see that how the money, how much money was actually generated by just a deposit of 100 rupees. This will convert into more than 480 rupees. Actually, if you have that much of banking system deep down in the rural or in the wider spectrum of areas. Done with this. Money multiplier का formula बहुत ही simple है. That is the broad money divided by reserve money or 1 by the reserve ratio. Reserve ratio, we can say that we have reserve ratio, cash reserve ratio of 4% and SLR of 18% and other ratios also, which are the reserve requirements of RBI currently. Now, this question basically talks about, this was a bit tricky question which UPSC asked. It talks about the Basel III Accords, or you can say simply Basel III norms. What were these Basel III norms? Why was Basel Committee on Banking Supervision formed, and when did it released its Basel I and Basel II norms? Basel III norms were released post 2008 financial crisis, the global financial crisis of 2008. उसके बाद ये norms आए. These norms basically talked about the strength, resilience and capacity of the banks to have higher liquidity and to have high quality liquid assets with themselves. The question asks, this Basel III norm was often seen in news, and this is to develop the national strategies for conservation and sustainable use of biological diversity, or to improve banking system, or to reduce greenhouse gas, or to transfer technology from developed countries to poor developing countries. This was basically for the banking system in order to ensure that banking system has enough resilience into itself to sustain the economic stress and economic, you can say, risks. How does this ensure, or how does the, you can say, banking system ensure stability into itself? The concept of liquidity coverage ratio was given, and under this concept, all the banks were supposed to keep a reserve of 30 days survival. That is, all the withdrawals which bank should predict, or bank predicts that it may face in the next 30 days, all these reserves have to be kept in high quality liquid assets. These high quality liquid assets, they can be either deposits with central banks, or they can be into the government bonds, or you can say government securities. These high quality assets will be available with the bank so that the banks may not face the liquidity crunch at a time, because this 2008 crisis was basically defined or derived by this liquidity crunch itself of the banking sector. Basel III, it has other conditions also. One of it was the liquidity coverage ratio. The other conditions, you can go through leverage ratio, you can go through the conservation or the buffers which it asks the banks to create so that they do not face the adequate or the immediate effects of the withdrawals. Done? That is Basel III. Lastly, we have one more question that talks about UPI. It says, what is the most likely consequence of using UPI or of installing UPI by people or implementing UPI? Basically, UPI had a clear objective, or you can say you might have heard of the direct benefit transfer, that is to replace and plug in all the leakages which were highlighted by the then Prime Minister Sanjay Gandhi, that they said that if 1 rupee is released from the center, only some paisa of it reaches the consumer or per se the beneficiary of that government scheme. Basically, the leakages in the subsidy sector, particularly the public distribution system of India, and the other, you can say, the LPG, urea, all the other sectors which were subsidized, highly subsidized by the government, had leakages into it. In order to plug the leakages, this UPI came into effect, and it said that this will help in direct transfer of subsidies, that is the direct benefit transfer for poor people, and this will become very effective in nature. Done? Next, architecture of UPI. UPI basically works on all the smartphones, per se, if the smartphone allows. It also works on those phones which are not smart, or which are the GSM based smartphones, by just the code *99#, and this interface of UPI, or Unified Payment Interface, basically this links all the banking structure which is present in our economy and the banking system or the payment settlement systems. It links all of them, and then the interlinkage makes the payment hassle free, and immediately the payment is reflected in the receivers and issuers the account. Now, next we have, I guess, the last question of the day. No, we have one more question after this. That is, with reference to digital payments, consider the following statements. There are very simple question hai ye, bahut hi simple question hai. It says, with reference to digital payments, consider the following statements. Bhim app allows the user to transfer money to anyone with a UPI enabled bank account. That is what we just read about UPI. UPI से क्या होता है? अब भीम ऐप से होगा या नहीं होगा, that is something secondary, but UPI से ये होता है, हाँ, we know that. Second, while a chip PIN debit card has 4 factors authentication, Bhim app has only 2 factors of authentication. ठीक है? The point here is, do you know about the Bhim app? This too was launched by NPCI and this too is merged with UPI only. Bhim app has 2-factor authentication, that is true, but your ATM card does not have a 4-factor authentication or authentication. What does that mean? We will discuss that. Before that, you need to remember that yes, Bhim app allows transfer of money because that is the sole purpose of UPI. Now understanding the question, answer was 1, but 4-factor authentication is not allowed on ATM cards. What is 4-factor authentication? Simple. A person going to ATM, what he will face? He has to enter, understand one thing. He has to insert his card, ATM card, then enter a PIN, then give his biometrics, and not only biometrics, he will receive a OTP on his phone, and then only he will be able to withdraw the cash. That is a 4-factor authentication. But actually what happens at ATM is, you just insert the card, enter the PIN, and you withdraw your cash. The 2 more options or the 2 more steps or factors of authentication are not applicable in terms of the transactions which happen in the ATMs. Done? That is where the question was wrong. Second, Bhim app, it has multiple functions, and this was basically to understand and make the payments hassle-free on UPI payments per se. Last, we have a question on digital rupee. RBI had the sovereign, this digital rupee was a sovereign currency which was issued by RBI, and this is aligned with the monetary policy. Now remember, digital rupee was issued by RBI. If RBI is issuing something, it must align with the monetary policy, because monetary policy is the core domain of RBI. Monetary policy is not framed by any other authority, it is framed by the Monetary Policy Committee of the RBI itself. So therefore, this digital rupee, if issued by RBI, must comprehend and must go parallel with what? With the monetary policy of RBI. That is the first statement. It appears as a liability on the RBI's balance sheet. Shall it appear as a liability? Yes. It is insured against inflation by its very design. That is, digital rupee को ऐसा बनाया गया है कि चाहे inflation कितनी भी हो जाए, इसको फर्क नहीं पड़ेगा. Do you think any money in this world shall exist in such a manner that inflation will not affect it? I say that even the non-living things are affected by inflation, or non-human things are affected by inflation. Everything is affected by inflation. Second, it is freely convertible against the commercial bank money and cash. Yes, that was the basic feature of this digital money while it was introduced. Inflation wala point jo hai, that is wrong. Inflation basically per se comes along with the money supply. Once the money supply increases, the demand increases. Once the demand increases, the price of the product increases, because too much of a money fetching too few products creates the demand and scarcity, or you can say demand supply contradictions in the market, and the scarcity which is created in the market actually leads to the rise in prices of that product. That is how we understand the concept of money supply. Done? So therefore the answer to this question was not 3, D was the answer. What is digital rupee? This was secure and quick digital form of cash. You can send or get the digital rupee virtually. Is it similar to UPI? Yes, UPI is an interface for digital rupee and it is a form of currency. Digital rupee, is it similar to cryptocurrency? No, cryptocurrency is decentralized, while as digital rupee was issued by RBI and its denomination, and this will not change. It is regulated by the RBI, it's not decentralized. Digital rupee, and the deposits which you make in the bank. Simple, if you are making deposits into the bank, if you are saving your money into the bank, is it different from digital rupee? Yes, digital rupee balance in your account will not attract interest because it is the same amount of money which you which you invested or which you saved into your account and then converted it into digital rupee, so that your transactions become easy. Therefore, the same amount of money cannot attract interest twice on the same amount or in the same account. Done? With this, we are done with today's sessions. We discussed 10 questions. I wish you all the best from SRIRAM's IES. Thank you for joining in here. Jai Hind.